Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked, where we turn tax panic into tax planning. I'm David Robson, your guide to strategies that keep more of your money compounding and less of it subsidizing the government's coffee budget. Today's topic, tax loss harvesting. Market dips feel lousy, but with a clear plan, they can become real, measurable savings. In this solo episode, I'll explain what tax loss harvesting is, who benefits most, how the offset rules work, and the big trap to avoid. The wash sale rule. We'll also hit timing tactics, cost basis choices, Missouri considerations, business owner nuances, and a few case studies. My goal is practical. Give you a playbook you can implement with your advisor, and a checklist to avoid unforced errors. As always, this is education, not individualized advice. Talk to a qualified professional who understands your full picture before trading. Seatbelts on. Let's turn red ink into green outcomes. Tax loss harvesting is the deliberate sale of investments at a loss to create tax assets. Those realized capital losses first net against your realized capital gains. Short-term losses offset short-term gains. Long-term losses offset long-term gains. After you net within each bucket, any remaining loss can cross over to the other bucket. If you still have a net capital loss, up to $3,000 per year can offset ordinary income on a joint or single return, $2,500 if married filing separately. Anything beyond that carries forward indefinitely until used. Here's why it matters. Taxes are a drag on compounding. If you can reduce today's tax bill while keeping market exposure, you give your portfolio more runway. Harvesting doesn't change what the market did. It changes how your after-tax results look. The key is staying invested while respecting the rules so you're not turning a paper loss into a missed rebound. Who benefits most? Three groups jump to the front. First, high net worth investors who routinely realize capital gains, whether from rebalancing, trimming concentrated positions, or selling real estate and investments. Second, small business owners facing liquidity events. Think partial equity sales, earnouts, or selling a rental property. Third, anyone bracing for large year-end mutual fund capital gain distributions inside taxable accounts. Losses you bank earlier in the year can neutralize those surprises. There's also a stealth benefit. Lowering net gains can reduce exposure to the 3.8% net investment income tax, and the $3,000 ordinary income offset can trim adjusted gross income. Lower AGI can ripple into deductions, credits, and even Medicare IRMA brackets. For Missouri residents, the calculus has actually shifted here. As of the 2025 tax year, Missouri became the first state in the nation to fully exempt individual capital gains from state income tax, so harvesting losses no longer saves you anything on your Missouri return the way it used to. The state-level benefit is effectively off the table for individuals now. That doesn't diminish the federal-level value of harvesting, though. It just means the double benefit pitch needs to go. Note also, this only applies to individuals and pass-through entities. C corporations don't get the exemption unless Missouri's top individual rate drops to 4.5% or lower. Bottom line, if capital gains or AGI thresholds matter to you, harvesting still belongs in your toolkit. Just know the win here is federal, not state, if you're a Missouri resident. The biggest booby trap is the wash sale rule. If you sell a security at a loss and buy a substantially identical security 30 days before or after the sale date, the loss is disallowed. Note the window is 61 days total, 30 days before, the day of sale, and 30 days after. Disallowed doesn't mean lost forever. It's generally added to the cost basis of the replacement shares, unless you triggered it inside an IRA or 401k, in which case the loss simply vanishes. The rule applies across all your accounts and your spouse's accounts, including taxable, IRAs, and workplace plans. That means a contribution, fund purchase, or dividend reinvestment can torpedo your deduction. The fix is planning. Coordinate trading across the household, pause drips, and choose replacement funds that are similar, not identical. Keep good records of trade dates so you don't accidentally step back onto the same banana peel. What is substantially identical? Think same security or same share class. Selling Vanguard Total Stock Market Admiral shares and buying the ETF share class of that same fund within 30 days likely trips the rule because it's the same underlying portfolio. Selling one S&P 500 index fund and buying another S&P 500 fund from a different provider is usually not substantially identical because the underlying indexes, sampling methods, and prospectuses differ. ETFs make this easier. You can sell a broad market ETF and buy a different highly correlated ETF tracking a similar index to maintain exposure. Actively managed funds require more care. Same manager, same strategy can be too close. Now the crypto wrinkle. As of today, the wash sale rule doesn't apply to cryptocurrency, so you can sell and immediately rebuy. But proposals come and go. Always check current law before acting. Rules change. Tax regrets linger much longer than headlines. Here's the replacement playbook. Step 1. Identify the position with an unrealized loss and confirm your cost basis method. Step 2. Sell the lost position. Step 3. Immediately buy a similar, not identical security to keep your market exposure. That could be swapping an S&P 500 ETF for a total market ETF, or a growth index for a blend index. Step 4. Wait 31 days. After that window, decide whether to switch back to your original holding, keep the replacement, or rebalance elsewhere. Timing matters. Don't wait for December. Harvest opportunistically during drawdowns and coordinate with big events, RSU vesting, a business equity sale, or a rental property disposition. Keep an eye on mutual fund distribution calendars. Many funds distribute in November or December, and you don't want to buy right before the taxable payout. A year-round, rules-aware cadence converts volatility into deductions without dismantling your asset allocation or your long-term plan. Cost-basis choices drive results. In taxable accounts, use specific lot identification, not average cost, so you can target the highest loss lots. Confirm your custodian default before trading and document which lots you're selling at the point of trade. Next, keep harvesting in its lane. Don't harvest inside IRAs or 401ks. Losses aren't deductible there. In taxable accounts, weigh trading costs, bid-ask spreads, and potential short-term capital gain creation from rebalancing. Stay true to your target allocation. The goal is a tax benefit without changing your risk profile. Pause dividend reinvestments, DRIPs, in the 61-day wash sale window, so reinvested shares don't spoil the deduction. For mutual funds that trade at NAV, spreads aren't a concern. For ETFs, place limit orders and avoid illiquid funds. Finally, keep good records, trade confirmations, lot IDs, and a running schedule of harvested losses and carry forwards so your tax pro can reconcile 1099s accurately each spring. Harvesting touches more than Schedule D. Lower net gains can reduce or eliminate the 3.8% net investment income tax. The $3,000 ordinary income offset can lower AGI, which may help with itemized deduction phase-ins, the child tax credit, education credits, and Medicare IRMAA brackets. Missouri listeners, this one's changed. As of the 2025 tax year, Missouri became the first state in the nation to fully exempt individual capital gains from state income tax. So unlike in years past, harvested losses won't trim your Missouri bill anymore because there's no state capital gains tax left to offset. The benefit here is federal only if you're a Missouri resident. Business owners, a few cautions. Capital losses do not offset depreciation, recapture from Section 1245 or 1250 property. That's ordinary income. With real estate and business assets, watch the Section 1231 netting rules. 1231 gains can be capital in nature if net gains, but 1231 losses are ordinary. There's also a 5-year look-back that can recharacterize gains as ordinary to the extent of prior 1231 losses. Coordinate harvesting with K1 activity so your year-end picture nets the way you expect, and plan estimated taxes accordingly too. Charitable giving pairs beautifully with harvesting. Donate appreciated winners to avoid capital gains altogether while still claiming a charitable deduction, and harvest losers to create deductions you can use now or carry forward. In high-income years, consider a donor-advised fund to bunch several years of giving while you offset gains elsewhere. A few rapid-fire case studies. 1. A client sold part of a business and realized a 7-figure capital gain. We harvested losses across equities and fixed income, donated low-basis stock to a donor-advised fund, and cut both federal and Missouri taxes meaningfully. 2. A surprise mutual fund distribution in December was neutralized because we'd banked losses during an October dip. 3. ETF pairs. Swap a total market ETF for an S&P 500 ETF for 31 days, kept exposure steady while booking the loss. 4. Crypto in a downtrend allowed repeated loss captures without wash sale limits, though we monitored legislation closely too. Let's land with a checklist. Identify loss lots. Confirm specific lot method at the custodian. Turn off drips. Select replacement securities that are similar, not identical. Execute same-day trades. Document trade dates and lots. Track 31-day windows on a calendar. Update your loss carry-forward schedule. Coordinate with business, real estate, and equity compensation events. Review mutual fund distribution dates. Monitor NIIT thresholds, AGI targets, and Missouri impacts. Use tools wisely. Direct indexing can automate lot-level harvesting while maintaining exposure. Many custodians offer loss alerts and easy lot selection. A proactive tax professional can integrate harvesting with estimated taxes, K-1s, Section 1231 items, charitable strategies, and your risk policy. Quick recap. We covered what harvesting is, who benefits, how offsets work, wash sale rules, crypto's wrinkle, timing, cost basis, pitfalls, Missouri angles, business specifics, and giving synergy. If this saved you a headache or taxes, subscribe, share, and let's keep unlocking tax smarts together.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.